Agree Realty is a REIT that pays monthly dividends. It is down 15% over the last 12 months, whilst also towards its 52-week lows. Let's take a deep dive to see if this REIT that pays monthly dividends at a yield of 5.3% is currently undervalued and one you should be adding to your portfolio, as REITs are looking very, very nice in terms of strong upside in the future. As always, we're going to do a deep dive into their numbers, their top line revenue, their bottom line net income. We'll also look at the health of this company, their total cash versus their total debt, and we'll compare them to a lot of other well-known REITs in a very similar industry. Quite importantly, for this monthly pair, we will be taking a look at their dividend safety. We'll run through some metrics to understand whether or not this company is a strong one for the portfolio. And we'll look not just at any insider buys or sells, but we'll also look towards the institutions to see what their movements have been. And they have just released their latest investor presentation, so we will pull out a few slides that are of interest to share with you in today's episode. And as always, we will put them through that valuation model, getting to our intrinsic value, getting to our acceptable buy price, given our investor margin of safety, and look towards Wall Street to see if they believe there is enough upside to warrant this as a very strong buy now. So taking a look at the historical performance of this REIT, firstly we can see both Seeking Alpha analysts as well as Wall Street are considering this a fairly decent buy. Now over the last year it has been plummeted down 15%, just year to date it is down nearly 10%, but if you've been a shareholder over the last 10 years you would be up 90%, although bear in mind, given this is monthly dividends, if you were to reinvest them over the last 10 years, it would be fairly high. And we can see, in fact, the highest point of this company has been around $80 pre-COVID, although it did touch that very similar point as we can see in summer 2022. Now, it does have a P to FFO at just below 14, so let's get straight into the analysis and start with their top line revenue. Now, for REITs, we want to see 5 to 10% growth year on year. We can, in fact, see over the last 10 years, they have grown from 54 million on their bottom line to 540 or just under in their latest annual accounts. So they are growing at a very rapid rate, and this can be seen here at a graph over the last 10 years. This is what you do want to see with REITs, growing revenues as well as growing AFFO, adjusted funds from operation per share, which we will touch upon soon as well. In terms of the bottom line, also been growing as well. We can have a look at the graph. Firstly, we can see moving in the same direction as their top line, and we can see it has gone from 18.5 million to 170 in the latest annual report. So both top line, both bottom line, they are both growing at a very strong rate. So far it is looking very good. In terms of their total cash versus total debt for a quick health analysis, well, 5.4 million reported in December 2014, 10.9 in their latest annual report. So their cash, although it has been pretty inconsistent, we can see it is essentially doubled from their cash balance at the last 10 years. In terms of comparing that then to their total debt, we can have a quick look for this REIT, and we can see very common as well. We'll discuss it in further detail later, but it has gone up 224 million, now currently sitting at 2.4 billion, something that is typical with REITs, and this graph does show that. Not necessarily a red flag indicator either straight away. In terms of looking at their competitors in the industry, so retail REITs, we have Brixmor Property Group, Philip Edison's, and a few others. We can see over the last year, now this includes those dividends reinvested, they would be down around 11.3%, making them the worst retail REIT from their competitors. Expanding that to the last 5 years, we can see pretty much flat. So over the last 5 years, if you were a shareholder, you were reinvesting the dividends, you would had essentially no return. Pretty poor, especially if you factor in inflation. When we expand that over the last 10 years, however, it is the best retail REIT from this six bunch at 195%. So always zoom out, as always, when you are a long-term investor, never look at the short term, but also factor in that past performance is never an indicator of future performance, and do understand that and factor that into your investment thesis. Now, in terms of growth grades, well, right off the bat, an A- score, so fairly decent. The 3-year historical average, they've been growing their adjusted funds 7.3% year on year above the sector median at 4%. Same over the last 5 years, just under 7%, whilst the industry average does sit around 2.3%. And we can see the growth forward looking is also looking very healthy comparison to others in the sector. So overall, looking very healthy. The one point where they do get not too great is their dividend growth rate, although when you do look over the last 5 years, they have been on average increasing that dividend at 6.4%, with the sector median being a lot lower, and we will dial into this when we do look at their investor presentation, as they have released some information on this. In terms of the profitability grade, well, we do get an A, as we can see here. In terms of their AFFO total revenue, 74%, very strong and healthy when you compare it to the sector median at 39%. Overall, though, we do see some C pluses. In terms of the payout ratio at 74%, this is what we do typically see in this industry, around the 75% level. So whilst it does get a C plus, in my opinion, it isn't actually as bad as it is made out to look, and hence why we do get an overall A grade, which I do believe is fair for this REIT. Now, in terms of their dividend safety, let's jump into this very soon. Let's first look at insider ownership, and a lot of good news. What we can see here is 7 insider buyers over the last 12 months, totaling 13.4 million. We can see a fair number of buys nearly every single quarter over the last few quarters. And when we do take a look in detail, we see the Chief Accounting Officer, Stephen B, buy 450 shares in the middle of March. Not the greatest amount at 25,000, but when we do go back, in fact, the chairman himself, Richard Agree, as well as Joey, the CEO, not too long ago, towards the end of February, have been buying a fair number of shares totaling around that $1 million mark, or just over. So in my opinion, very, very bullish when you do see insiders, especially the chairman and the CEO, buying shares. Let's be honest, they are a lot closer to the business than you and me as investors, and they obviously know where the business is heading. So in my opinion, they only buy if they believe it is going to be a lot higher than what it currently is. So take that as a bullish signal, but as always, do your own due diligence. Institutional ownership, while 98%, very high. 1.16 billion worth of sales by the institutions over the last 12 months. Nearly the same amount of buyers, although marginally less at 990 over the same period. And we can see in Q1 and Q2 more selling than buying. In fact, in 2023, the opposite for the two more recent quarters in 2023. And whilst we don't have the full data set available yet for Q1, we do note 31,000 buys over sell. So factor all of these in when you are looking at companies, when you're doing your own research, but always come up with your own final decision. Now, just to let you know, we have literally just half an hour ago released our latest free weekly article. We are looking at 10 stocks with a massive upside. In fact, the previous article also we looked at more undervalued dividend stocks, all completely free. If you want to gain access to all of these articles, do click on that pinned comment below. Once you sign up, you can start reading these all straight away. Now, taking a look at their latest investor presentation, what we can see here, April 2024, so literally just a few days ago. A few things that we did want to highlight. The first one being who their top tenants are. Now, Walmart, Tractor Supply, Dollar General, Best Buy, CVS, a lot of strong companies. And what is positive to note here, a few things. Firstly, their largest tenant in terms of the base rent makes up 6%. So we're not looking at a few tenants that make up a large bulk of this company. So for me, that is a positive. When you look at the list of companies, we have Lowe's, Kroger, Dollar Tree, TJX, a lot of companies that in my opinion are completely strong in the industry. On top of that, what I quite like to see is a sector analysis. Again, grocery stores just makes up 9.6. You have home improvement coming in a close second at 8.7. And then you have tire and auto service, convenience stores. So in my opinion, they do hold a very strong set of tenants. No worries in terms of affecting their numbers. And when we do take a look at their monthly dividend, a few things to note. Again, I want to reiterate the fact they do pay dividends on a monthly basis. And on top of that, their target is to have average AFFO payout of around 75%. Over the last 10 years, it has hit around 76%. So not too bad at all. And over the last 10 years, on average, they have been increasing those dividends by 6%. That is above the inflation target that we have on this channel of 4% or more. So positive to note there as well. Now, dividend safety score 70, it does look to be safe. Market cap 5.7 billion. It is a mid-cap company. Now, in terms of the last recession, well, unfortunately, they didn't raise the dividend. They didn't even maintain it. They did cut it 07-09. They had pretty much average growth during the period at negative 14%, and they also trailed the S&P negative 67, whilst the S&P came in at negative 55. One thing that I'm not too happy about is their more recent increase. In fact, just this month, they increased the dividend by 1.2%. Now, as we all know, average inflation rate over the last 40 years in the US was 4%. If you are getting less than that in your dividends, your salary, your other income producing assets, you are in fact taking a pay cut, losing your purchasing power. So 1.2%, not great, in fact lagging behind inflation. Over the last 5 years, however, 6%, nice to know, a lot better. Over the last 20 years, as you can see, their dividend increases have lagged behind inflation, and we do note they have been increasing those dividends for the last 11 years. Now, dividend yield theory, for those that are new to the channel, it states a company is undervalued when the current yield sits above the 5-year average. Right now, we have a double signal of undervaluation, first on the yield as well as the forward P to FFO sitting below the rolling 5-year average. And what we would say is that yield is pretty much the highest yield they have offered over the last 5 years, as well as this being the lowest over the last 5 years. And we do note it isn't too far off the sector P to FFO of 13.3. Another thing just to note, any of these models, none of them we look in singularity. We do conclude towards the end, so do bear that in mind. 90% is the general blanket preference for REITs. What we can see here for ADC, around 75% pretty much every single year, expected slightly lower in 2024. Now, free cash flow per share and any other free cash flow metrics for REITs isn't something we look at given the fact it is a lot more volatile. So we draw your attention to the adjusted funds from operation per share, the AFFO. Nice to note it has been increasing over the longer term and it is expected to increase again in 2024. When we look at it percentage-wise, nice to note it has been increasing over the last 10 years, 2024 expected at 4%. And as we did analyze earlier on, we can see they are smashing through that 5 to 10% growth on the top line year on year, latest increase being 25%. In terms of the shares outstanding, now again, this is very typical for REITs. In fact, they are unfortunately one that do dilute your position at a very rapid rate. When you compare it to others in the industry that we have reviewed, this would be sitting there at the top level. Now, the reason why REITs do this in the first place, they do need to issue equity to fund a lot of their property acquisitions after paying those dividends. Now, as you can see here, they have been increasing those top line numbers at a very rapid rate. For REITs, for ROIC metric, which is a very important metric, we do look for 3 to 5%. Granted, it has been decreasing over the last 10 years. The last 4 years, consistency at 3%. We do want to see that as a very, very minimal baseline. Operating margin, very nice numbers, but again, it has been decreasing. Do consider that in your investment thesis. We don't want to see this trend go lower and lower. That will impact their bottom line. Finally, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, correlating to dividend safety as well as balance sheet strength. Below 5.5 preference for REITs. Now, what we can see over the longer term, it has been straddling around that year on year. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. Positive to note, 2024 is expected to come much lower at 4.73. We also do note the AFFO is looking low around that 73% level in 2024. No real worries to the dividend as well. We also saw that dividend safe score of 70. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first valuation model for ADC. It is the multiples valuation. We have companies in a similar sector and size that we did review earlier. Their average P to AFFO as well as that of ADCs. We get an intrinsic value sitting at around $60.18 with our first undervaluation signal. We then move on to the second model, which is the dividend discount model. Do bear in mind any of these signals we don't look at in isolation, and we will conclude towards the end. As we mentioned, the growth rate looking a little bit low in the more recent year. On average at 3.3%, we've gone essentially near enough that forward looking at 3.5%. Given that they are very proud, they have been increasing it over the last 10 years at 6%. We would expect this, in fact, to be much lower than the reality that we will see shortly. In terms of looking at this then, we do see the market value lower than the intrinsic value with our second signal of undervaluation. And as we mentioned, DCF model isn't one that we do use for REITs, they are a lot more volatile. So what we can see in today's episode, the intrinsic value does arrive at around $64. Now, don't forget you can click on the pinned comment below where you can get to the acceptable buy price as well as the intrinsic value of companies in your own portfolio, as well as those on your watch list by clicking on the pinned comment below. Margin of safety then, 10%. We execute if it meets 3 criteria: the wide moat, the strong financial metrics, and the good forward-looking data. If we believe that, it is pretty much a buy at around that $57 mark. Now, what this signals then, Agree Realty, we see it as a 10% MOS level based on our estimates and judgments today. For those looking at 15%, it would be around $54, and those at 20% around $51. So with the 10% MOS level, Wall Street, in terms of their forecast over the next 12 months, see upside of 16%. They do have their own price target of $66.15. As always, do let us know your thoughts in the comments below. Is this one that you are looking to add to your own portfolio? Maybe you prefer the other REITs. We have just recently dropped our video of Vici Properties, one that we also added to yesterday. Or maybe you do love the original monthly dividend payer Realty Income. Whatever it is, let us know your thoughts below. Don't forget, if you enjoyed the episode, smash that like button, hit that subscribe and bell button so you don't miss any of these videos as they drop. And as always, we'll see you all on the next one.